Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio. The purpose of this video is to show you how business is what drives markets. Business people get all this information from the Fed, tightening, easing, raising interest rates, lowering interest rates, the government deficits, all this bunch of information, and they have to filter this information and eventually they have to make decisions. I think it's these decisions that are the important thing to tell you where the markets are going to go, not what the Fed or the fiscal or whatever. It's how the information is interpreted by the decision maker. So the purpose of this video is to give you a view of just a small part, but it gives you an idea how everything is intertwined and connected together. This chart has three panels. There are three different quote-unquote markets, sectors of the economy, but they are very closely related. The first panel, this one, the top, is our business cycle indicator. This is computed simply from market data. So this is what the stock market is telling us what is happening. When it rises, is associated with a stronger economy and defensive market. When is declining, it suggests it points to a weak market and defensive stocks or defensive strategy is the most appropriate one. And this is the business cycle indicator. This one in the middle is the ISM Purchasing Managers Index new orders. So as you can see, they have been rising. Here they peaked in early 2024. They went down, and then they started going up towards the September 2023. Now they are coming down. The panel here at the bottom shows two indicators, two measures. One is the 10-year yields, and one is the CRB, is the commodity price index. So as you can see, commodities and interest rates move very close together. Why? Because business, when they decide that the economy is strong, they have to buy commodities and they have to borrow money to expand production. And they need more commodities to make the products. This drives the prices of money up and it drives the price of commodities up. When instead the economy is weakening, then what happens? They buy fewer raw materials and they borrow less, and therefore interest rates and commodities decline. That's the reason they go together, because they are part of the manufacturing process. Is the outcome of the decision-making process of businessmen deciding to improve production or lower production. Now, these three curves, as you can see, they are correlated very closely. When the purchasing managers say things are improving, so the curve more and more, the index rises, our business cycle indicator rises, and yields are rising. Here there was a lull and yields decline. Then it started going up. The same thing happened to the business cycle indicator. Here rose, strengthening the purchasing managers, rising in interest rates and commodities. Here the business cycle indicator, the markets, the stock market decides that things are going to slow down, becoming more defensive. The purchasing managers index declined, and yields and commodities declined. Here purchasing managers started ramping up production, and because they see better times ahead, and you could see the business, this was reflected in the stock market with the business cycle indicator strengthening. And guess what? You can see how the commodities and interest rates are rising as the purchasing managers index improved. However, lately what you see three trends. The business cycle indicator is declining. meaning that the economy, the market believes the economy is going to slow down and is becoming more defensive. The purchasing managers index declining, suggesting that the purchasing managers, more and more purchasing managers saying things are worsening. And guess what? The commodities and interest rates also peaked and started declining. So you see how the connection between business decision making up and then down, with the stock market more aggressive, more defensive, and with interest rates and commodity rising and now declining. So what is the point? The point is that right now we see that the purchasing managers index declining is telling us that manufacturing is not going to do well. These are new orders are declining. That tells you that with new orders coming down, production is going to be weak. And of course, if production is weak, what happens? Management borrows less and buys fewer materials, so prices declining. The market is reflecting all this with our business cycle indicator declining. So these are the important trends right now. Weaker economy, slowing down, declining yields and commodity prices, and with a business cycle indicator that says the economy is slowing down. By the way, in a future video, I will show you how the business cycle indicator is related to earnings. And right now, because of this weakness that is expected, that has been pronounced since 2024, slowing, you will see that earnings are also now on a year-over-year basis are showing no growth. So there is a sense of cautiousness in the marketplace. We have 3 membership to the Peter Dagg's Business Cycle Academy. Membership number 1 is we have only videos. Membership number 2, videos and financial updates, economic updates. Membership number 3, the Peter Dagg portfolio, which is a 22 pages report twice a month. Videos, we have model portfolios and market updates. Thank you very much for reviewing this video. I really appreciate it. I hope you'll find it informative and useful to your investment strategy. If you want to know more details, please do go to www.patreon.com/Peter Dagg for all our financial information and reporting. Thank you very much, and I hope to see you really, really soon. So long.